I hope my screen is visible to you all.
Yes, yes.
Sure. Okay. So, hi everyone. Very good evening to you all, and welcome to live session of our course on corporate finance. And today we will be discussing the content of week 4. So, in week 4, we broadly touch upon mainly three topics. First one is like the how we calculate maturities and durations. Second was inflation, and third one is yield curves. So first we take a look at like what do we mean by maturity and duration, how these two things are different from each other. So maturity is, in very simple words, it is like the time to the last payment. So if I am getting my last payment after 30 years, then maturity is 30 years. If I'm getting my last payment after 2 years, then maturity is 2 years. It is very simple. But like this does not account for like the amount of cash flow or amount of payment I am getting each period. So for that, a new measure which we call the duration, that is given. And what is the duration? Duration is like payment weighted average of all payout times. So for example, if you are getting a payment of c at particular time t, and there is a cash flow for like few periods, then duration is given by like the weighted sum of times, and these weights are the cash flow or the amount which you are receiving on that particular time. Okay. And now a new measure is also given which we call the Macaulay duration. Here like these weights are like the substituted with the present value of these cash flows. So in the calculation of duration, there is no role of interest rates, but in the Macaulay duration, we calculate the present value, so we discount them with the like the particular discount factor which we calculate from the prevailing interest rates. So let's understand this with an example. So here it says like there is a bond which has a current price of 900 rupees, and this bond promises to pay 250 rupees after 5 years, 500 rupees after 10 years, and 750 rupees after 15 years. And it is also said like the prevailing interest rate is 5% per year, and it asks you to calculate like maturity, duration, and Macaulay duration, and the definitions are given in the previous slide. So I will take a pause of like 20 seconds and ask you to attempt, and then I will show you the solution and we can match the answers. So the calculation of maturity is very simple. So you are getting like in this bond, this bond is paying its payment until like the last payment on 15th year. So maturity is very simple. It is 15 years. Now to calculate duration. So for duration, like the the numerator will be like the weighted sum of all the time periods. So in the after 5 years you are getting 250, so 250 times 5, 500 times 10, 750 times 15, and you divide it by the sum of all the payments. So 250 plus 500 plus 750, and if you do this calculation, you calculate your duration is 11.67 years. So whenever we talk about any cash flow, so duration gives a more reliable. So it is not, so if you are getting 100 rupees for 50 years versus you are getting like 5,000 rupees after 50 years, these two are completely different things. And so that's why like maturity gives like how long we are getting payments, but duration gives like how much and for how long we are getting And the Macaulay duration, similarly, we can calculate Macaulay duration also. And here we have simply replaced these cash flows with their present values. And by calculating this, we get the Macaulay duration to be 10.93 years, which is approximately like 11 years, if we see. So I hope this, like the concept of maturity and duration, is clear to you all.
But sir, in practical, what is the significance of this duration? Why should I need to calculate it, and where I can use it to take decision?
So duration, like in duration, we are also accounting for the amount which I am receiving on a particular time. Correct. So in the class also, if you remember, like in class, it says like here I have given like the similar kind of payments, but in class, like a bond which pays 1 lakh rupees in first year, and then like the 10 rupees or 100 rupees after 30 years. Correct. There is no in between. So if you calculate the maturity, then maturity is 30 years. But effectively, you are receiving almost all of majority of your payment within 1 year. So 30 years is like long away. That is not giving you the actual sense of like the how long, how what is the total time in which you are getting your money back, kind of that. So in maturity, like there is nothing, only the time dimension is there.
So, for any financial asset or instrument, the duration is always less than maturity.
Yes, in most of the cases. It may be same, but it cannot be more than maturity.
Okay.
Yeah. So I don't recall if we use, but yeah, duration gives us a sense like of like how much and how long we are getting the payments. But in maturity, we are only getting like these two are the kind of measures from which like you get like how long your payments are coming for in
Yeah,
given.
why I am asking this? Because in bank and any other places, the term maturity is always means
Yes.
people know what is maturity. Your fixed deposit will mature on
Yes.
certain date, but nowhere this duration term is used. That's why I'm asking.
Yes, so I will also look into it, like where this duration concept is used. So I do not recall any particular ops, like I am not getting right now, but surely I will like the if I get something like I will like make you aware about it. Okay.
Okay. Okay.
So next topic which we discussed in last week was inflation. So and various in between topics also. So first of all, like why inflation is important. So because like in very layman terms, inflation is nothing but it is the change in price levels. So for example, like the price level in the current period is pt and price level in the previous period is pt minus 1, then inflation is like difference in these prices divided by the previous period price level. And why inflation is important? Because it impacts the like the buying power of your money. Correct. So inflation is simply it is giving like by how much the prices are rising in the economy. So if inflation is very high, then your money is valued less in the given period. Okay, so this is clear. Then we are saying this price level or price index, but how what is this price level? Because in the economy there are a lot of goods which are being sold and purchased. So how do we measure this price index or price level? So for that, like there were certain various concepts, like different types of price indexes are developed, and the most common is the consumer price index. So what do we mean by consumer price index? So in this consumer price index, what is done is like the authority, like for in the case of India, the RBI, it like the RBI the or the whichever authority which is like the calculating or measuring this price index, what they do, they fix a consumption basket. So what do we mean by consumption basket? So it it comprises of a fixed set of goods. So for example, you are an individual and you consume, they do a survey and they collect information on households, and then they fix, yes, generally households are consuming this set of goods. So for example, in India, households consume the common goods, like they consume food items, there is clothing which is required, there is fuel, they require a house, and certain other things which appear again and again. So they they constitute this basket, and then they observe the changes in prices of this basket. Correct. And there are um, two other major price index are there. So one is the wholesale price index, and another is GDP deflator. So if you understand consumer price index, if you have any doubt regarding that, please raise it here. Okay. So now wholesale price index is like consumer price index. There we calculated the prices of a basket comprising to a particular consumers. And for wholesale price index, here we take the prices of the goods which are sold in the wholesale market. We take those prices and we constitute our index. And GDP deflator, which we will be seeing later, like in GDP deflator, we kind of account for all the goods in the economy through calculating the overall GDP, taking overall GDP into account while calculating GDP deflator. Okay. Now in newspapers we regularly listen about, whenever the inflation data is out, it always says there are various terms, like the headline inflation is this much, so headline inflation is 7%, or core inflation is this much. So we should have a the gist about these terms. So headline inflation is nothing but like the inflation calculated using this consumer price index. And what is core inflation? Core inflation is if we remove the volatile, highly volatile items from the basket of the CPI, then whatever remains we call that core inflation. So that is the core. So the prices of those things does not vary much. So these two items are the fuel and food. These two are very highly volatile in Indian scenario. So if you remove these two items from the consumption basket, then whatever remains, and if we calculate inflation on the basis of that, then we call that core inflation. Okay. So now let's take an example of how do we calculate, first how do we calculate CPI, and how do we calculate inflation based on that. So in India, the this is I have taken this from our slides only. So this is so to calculate CPI or any price index, there is a certain base year which the authorities fix. So for example, in India, for CPI calculation, 2012 is fixed as base year. So what do we mean by base year? So by base year, we mean that we normalize the whatever price index which we get, we normalize that to equal to 100. So we will see an example of that. And the what I discussed slightly ago, the we fix a consumption basket. So in India, this, there are two separate basket for rural population and one for urban population, and these are the weights for different categories. So these major categories are food and beverages, clothing, housing, fuel, tobacco products, and miscellaneous, which include many different products. Okay. And if you how from where you can get these the weights, for that I think you need to visit the MOSPI website, the Ministry of Statistics Planning and Implementation. So I will share the link after the class in the chat. So if these weights are given to you, and if it says like the if we take a like the average prices of these different categories, for example, the prices of food is 50 rupees in 2012 and in 2013, like I have given prices in 2012 and 2013. And then the question asks like what is the inflation in 2013 considering 2012 as base year. So how do we calculate that? So for that, what we do, like we have the weights and then we have the prices, then we can calculate the overall or the average price for these 2 years, like 2012 and 2013. So if we calculate the prices, then we like the in 2012 the average price is 3436.07. So I have calculated for urban population, so I have taken the weights for the urban population and I leave calculation for rural population up to you. Okay, so in the urban, so if I calculate the CPI for 2012, so the total average value is 3436.07. But as I said, this is the base year, so this should be normalized to 100. So how do we do that? We divide it by the same number and multiply it by 100, so then it is like CPI in 2012 is 100. Similarly, we calculate the average price in 2013, that comes out to be 4075.59, and we normalize it again according to the base year. So in the base year, what we did, like we divided by 3436.07 and multiplied by 100. We do the same to the numbers which we get in 2013, and from that we get the CPI to be 118.61. So this is the CPI in 2013. Now if we have these numbers, then we can calculate the inflation. Inflation is nothing like the CPI in 2013 minus CPI in 2012 divided by CPI in 2012. And from that we get like the average urban inflation in 2013. If these prices were there, then that was 18.61%. This is how we do calculation for CPI and inflation. Okay, is this clear to you? I think we have few examples in our GA also. So if you have any doubt, please feel free to raise them. Now the another price index which was discussed is the GDP deflator. So first we should understand like what is GDP. So GDP is nothing but the market value of all the final goods and services produced in an economy during a given period. So generally we calculate the GDP for a particular year, and in India quarterly GDP numbers are released. So each quarter we calculate the total numbers, and on this GDP there are two types of calculations are done. One on the current prices, like for example, take an example of simple economy which produces only two types of goods, and then we simply like whatever price is today and number of whatever quantity is produced today, we simply multiply and sum, and whatever the final sum is, that is my nominal GDP. Another concept is real GDP. So what real GDP does is it only measures the like the change in production only, like the, and so it is based on the constant prices. So for what we do to calculate real GDP, we fix a base year the same way we did for the CPI also. So there we fixed the base year to 2012. Here also we fix the base year. For example, we fix if we fix the base year to 2012, then to calculate real GDP, what we do, we will use the prices of 2012 only. And if we use prices of that year and quantities of current year, then the number which we get, that we call as real GDP. And if we have these two numbers, then we can calculate GDP deflator, which is like defined by the ratio of nominal GDP to real GDP. So how this is a measure of price index? So what, in real GDP, what we have done, we have fixed the prices, and in nominal GDP, we are allowing prices to vary. So the ratio of that will give me the like the changes in price in comparison to the base year. So that's why we call this as a price index, GDP deflator also. So if you have the value of your price index, then you can calculate your you can calculate your inflation by simply using this formula. So for example, if you have GDP deflator value for period t and for period t minus 1, then you can simply apply this formula and calculate the inflation based on GDP deflator. It's simple as that. Okay. And I would recommend you to like visit the RBI website and its database website. And so let me see if it opens. So this blue colored thing, it contains the link. So here if you click on this link, it will take you to the database portal of Reserve Bank of India. And if you visit this portal, then there are a lot of data sets. So for example, this consumer price index data is available on the on the homepage of the website also. So if you visit that, then it will show you the CPI data for, and you can download this download the data from this website for free. So it is free of cost data. So it is highly recommended for you to like visit and like the go around various data sets which are available on this website. So for example, this is the CPI, and it has given for rural, urban, and combined. Combined means like it combines rural and urban both and gives a combined value. And here you can see the index value and the inflation also. And inflation is calculated on the the annual inflation is calculated. So what do we mean by that? So if you are calculating inflation for December 2024, then you will use price index in December 2024 against price index in December 2023, and from that you will calculate this inflation. Correct? And here you can have a look at like the, as we said, like there are six categories, and in those six categories, like the first one was food and beverages, and there are various subcategories into that also. So the RBI provides data for each subcategory also, and you can see like the you can have a look like which category is contributing more towards, or which category has the highest inflation. For example, if you see, like if you take a quick look at these data points, then you will see like the vegetables are consistently having very high inflation rate. So if you see like vegetables in December 2024, they have like, I am taking a look at combined value, then it is 26.56% in December, and it is having 29.37% in November, and similarly it is having as high as 42.23% in October 2024. So we see like vegetable prices are rising very highly, and which we see in our day-to-day lives also. So it is like, this is, I am just giving you an example of like from where you can get these data points and how these values are calculated in the real world. Okay, so this was our discussion regarding like the how do we calculate inflation, and now why inflation is important, because it changes my purchasing power of my money or my currency, whichever I have. Okay, so now it impacts the interest rates also. How? So interest rates are, what is interest rate first of all? So interest rate is like, if you are saving your money into a bank account or in any saving scheme, then whatever you earn on that, we call that interest you are earning. or if you take a loan, then you have to pay some extra amount on that. Then we call that the amount which you have to pay extra, we call that like this is the interest, this is the amount of interest which you have to pay. And we are discussing like interest rates again and again throughout our course, like previously, and coming forth also we will be discussing. So now, like, how inflation plays a role in these interest rates. So the values of interest rates which we listen from various reports or like in the newspapers especially, so those numbers are the nominal interest rates which we learn. So for example if like the any bank issues like it is giving you a loan on 10% annual interest rate, then this 10% is nominal interest rate. So this nominal interest rate does not or if a bank like the if a bank says like it is giving you 7% rate of interest on your FDs, then it is the nominal interest rate which it is saying. It is not accounting for the inflation rates. So the interest rates which account for that, those are real interest rate. So nominal interest rates are the interest rates which are defined in terms of currencies, and the real interest rates are the interest rates which are defined in terms of basket of goods, like how much goods or how many goods you can purchase with your money. And the relation between these two is given by this equation. So the like the 1 plus real interest rate is the ratio of 1 plus nominal divided by 1 plus expected inflation in the upcoming period. And we use a approximation very often because these rates are very small in like the in many times. Then if numbers are very small, then we can directly approximate with like the real. So I think there should be a minus here, it should be a minus, I think, correct? Yeah. So I will correct them. So the real interest rate is like the nominal minus the expected inflation. And an important note which was mentioned by the professor also, so which says like when you are calculating net present values, then if there are nominal terms like the terms which are mentioned in the currency values, then you should discount them with nominal interest rates. So for example, till now in our course we have nominal values, so we have defined our cash flows in dollars or rupees or units only, so we are discounting them with the nominal interest rates. But if your cash flows are defined in terms of goods, so for example if you it says like the a investment opportunity will give you payment in terms of certain goods, for example in form of gold or in form of bananas or in any other form, like in any form of good, then we call that like the payment in real goods, then we have to discount them with real interest rates. Okay. And now like let's have a look at an this approximation thing with an example. So when can we use the approximation and when we should not? So the first example I am giving, like here, like the values are very small, so it gives like nominal interest rate is 4% and expected inflation is 2%. Then what is the real interest rate? So we use the exact formula and the approximation also, and through exact formula we are getting real interest rate to be 1.96%, and through approximation we are getting 2%, and these two values are like very close, there is not much difference. But at the same time, if we do our calculation for higher interest rate values, so if the interest rate is 10% and inflation is 20%, then what happens? So in that case, like if you use the exact formulation, the real interest rate is negative 8.33%, and through approximation it is minus 10%. So these two numbers are not same. So when you have larger values of interest rates, then you should use the exact formula only, not the approximation. Okay. Now the third topic which we covered was the yield curve. And what is a yield curve? Yield curve is nothing but like the relation between the annualized interest rate and the maturity of the bonds. So annualized interest rate. So what is annualized interest rates? So which we studied at the end of week 3. So if you have an investment opportunity which gives a total, if you have the total return with you, you have to like the redefine that, like what is the interest rate which you have earned over 1 year. So annualized means like you bring down all the interest rate in 1 year interest rate terms, correct? So for example, so here the example I have taken, also like I have taken this example for India only. So this data I have taken from RBI website. So here it gives me interest rates for four different government bonds. First one has the like 91 days treasury bills, 182 days treasury bills, and 364. So first one is for 3 months, 6 months, and 1 year, and the fourth one is like 10 year government bond. So the government bonds which have maturity less than 1 year are called treasury bills, and which have higher maturity, those are called government securities. This is the general like the jargons used in bond market. And here these rates are given for two different periods. So first one is for like the rates given on 11th October, second given on 4th October. So these rates are revised weekly. So every week you get a different rates. So RBI releases them weekly. So here, what do we mean by annualized? So this is the 6.43 annualized rate of return for 3 month treasury bill. So what if I ask you like what is the total return of on a 3 month investment on a 91 days treasury bill? So this annualized return is 6.43. So now you have to if this is the annualized rate of return, then what is the 3 month rate of return? That will give you the total return which you are earning on 91-day treasury bill. So how do we calculate that? So we simply like the 3 month means 1 quarter, so 1/4 of a year. So doing this calculation, we can calculate like the return on a 3 month treasury bill, and that comes out to be like 1.57% given these data points. Similarly, like if someone asks you like what is the total holding rate of 10-year government bond, so the annualized rate of return is given to you 6.75%, and if you use that, then you can calculate the total holding rate of return, and that is like 92.17%. So if you invest 100 rupees in a 10-year government bond, then after 10 years that bond will give you 192.17 rupees after 10 years. And if you invest that on the given date, that date is 11th October 2024. Okay. Now, how this yield curve is important. So where this yield curve is used. So using this yield curve, we can calculate the forward interest rates. Like how do we do that? So for example, if questions ask what is the 1 year interest rate from like the, if it asks like after 1 year, if you purchase a bond after 1 year, then what is the interest rate which you will be earning on a 1 year bond? Okay, then how do you go for that? So following our the notations which we used in the class, so here like there is no quotation is given for a 2 year bond. So for that what we do, so we use like the we draw a line between the two given points, and then we calculate the value for, like, we consider the curve to be linear between any two given points, and for in between we can calculate using the linear straight line formula. And through that, so for example here we were given values for 1 year and 10 year, so we can draw a line between 1 year to 10 year, and then we can calculate the annualized rate for 2 year bond, and that comes out to be this 6.554%. And then we can use the the annualized rate of return and total holding rate of return, and we can, through that formula, we can calculate this R12, which is like if you purchase a bond after 1 year, and what is the return which you will earn on the coming year. So through that calculation we can calculate R12, and that comes out to be 6.58%. So this is an example of calculating forward rates, which means the rates that are in you are going to earn in future.
Sir, may I ask you one question?
Yes, yes.
Actually, in this question, sir, I have got a confusion that when you show me the graph, it gives the rates, okay, like for 1 year, for 2 year, for 3 years.
So here, like for example, I am using this data. So
Hmm.
here you are not given like the values for 2 year, 3 year, 5 year, etc. Here
Hmm.
only the data is given to you for 1 year and 10 year.
Okay, so that okay, we can use okay, by using the linear okay, equation
Yes,
formula
yes, yes,
that okay, we can find.
yes,
But okay, in the lecture, there was one that okay, it is starting from December 22 going to December 23.
yes,
So in that lecture, if we see the duration is 1 year.
yes.
So the interest rate, it should be for 1 year, but okay, professor calculated by using. So I'm confused about okay, the holding rate, annualized rate, okay, about that part only.
Okay. So the rates which are given to you, these rates are annualized rates of return, correct? The
Okay.
rates which are given to you in the yield curve, so if you take the graphical form or this tabular form, these rates which are given to you, these are annualized rate of return, not the total holding rate of return. So for example, if you take the 1 year example, so this is the, so for 1 year the annualized rate of return and total holding rate of return, those will be same, correct?
Okay. Yes. Yes.
Yes. So now if you take the example of maturity less than 1 year, so here for example for 91 days or the 3 month, so this is the annualized rate of return. So through that, how do you calculate your holding rate of return? Which I have done in here, like through this formula, we do this calculation and we calculate total holding rate of return. Correct?
Yes. It is the same formula which is for the compound interest.
Correct. Now, for the higher maturities, so for example, that for 10 years, so this is the total holding rate of return for a 10-year government bond. So we compound the annualized rate of return for the given time period or the given maturity of these bonds or these interest rates, and through that we can calculate total holding rate of return. Similarly, for example, if the annualized rate of return for a 2 year government bond is given to be 6.75%, then total holding rate for 2 year bond will be 1 plus RT, and here this power will be 2, and through that you can calculate the total holding rate of 10-year government bond. Correct? This you understand, correct? So now, if so, what here we have done, so here also, like, we have, through that straight line, we have calculated the interest rate for it, annualized rate of return for a 2 year bond, that is, that comes out to be this much. So that this R02 means like what you earn between period 0 and period 2. So 2 period. So this is the total holding rate of return on this 2-year bond, that comes out to be this.
This 6.554, how you got? You've done a linear
Yes, we did a linear. So what we do, so we have the values for 1 year and 10 year.
10-year. Okay, yeah.
Yeah. So we do
Taken
like,
the slope and added to the.
yes, correct, correct. Okay. So through that, so the we can calculate this total holding rate of return. Now we know that what is this 2-year rate of return. So whatever return which I earn in the first year, and the return which I earn in the second year. Okay. So the return in the first year, that is given to me like the 1 year rate of return, that is 6.53%, which is given to me. And I have first 1 year rate of return, and I have total holding rate of return, and I want to calculate what I will be earning up, like if I purchase a 1 year bond 1 year later. So this value I don't know. So but I can use these values and I can calculate like using this formula. So R12 means the return which I am earning from year 1 to year 2, or the period 1 to period 2 in the future, not the period 0. So this is the period 01. R01 is this, R12 is this. So if you are not clear, then I would recommend you to like just like the have a look at like how these rates are defined. So when we define rates by this R12, that means rate which you are earning on a bond, like which you purchase in year 1 and which matures in year 2. That is what which we mean by this R12. And why this R12 is a forward rate? Because it is in future. So it is in period 1 after 1 year, not in the current period. It is at some future time. That's why we call this interest rate as a forward rate.
Can this forward rate ever be lower than the spot?
Yes,
Correct. Okay.
yes. This can be like, it all depends on like the your yield curve, or the like the values in the yield curve. And we in the lectures also we discuss like different types of yield curves. For example, like mainly there are 4 types of yield curves, and in normal conditions, like the yield curve is normal, so which means like it is upward sloping. So the and like rate of return which you earn on shorter duration, which is lower, and on the longer duration it is higher. And why is that? Because when you hold an investment or a bond for a longer period, then you are accounting for a higher risk, because in a longer period there are more uncertainties. Things, many things may change in comparison to short term. So if you are looking for only 3 months versus 10 years, then in 3 months there is less likely to things to change, but in 10 years things may change. So there may be a change in the governments, or in many changes may happen in a longer period. So there is higher risk for a longer time period. So that's why in normal conditions yield curve is upward sloping. But there may be various types of yield curves. So for example, it may be flat, it may be inverted, that means downward, and it may be humped, which is like of this type.
So
So
the question, Mike, one more question. In
yes,
what economic conditions does the yield curve become inverted? Because that means suddenly my demand for the short term has
yes,
gone up,
yes. So
and I'm
that,
not.
yes.
So
So so why yield curve is important? This is also the case whenever like in economies we observe this inverted or the downward sloping yield curves. That is a kind of like the hint towards like the economy is going into a bad condition or into a recession. Not
okay.
exactly, we cannot be sure, but it is a very good hint for the authorities or the economists. So that means like economy is going into a recession. So if we have a look at like these yield curves are for US economy. So in 1980s, like there were very high inflation, and like that time, like the I think that Bretton Woods condition was like they have like the so Bretton Woods. So
Right. There was a oil glut also, sir.
yeah, yeah, oil glut also. So
Yes.
there was a lot of uncertainties at that time. So in the short term, so they were not knowing like what is going to happen next, what is going to happen next. So there are higher uncertainties in the short term. So things were changing very quickly. That's why the the returns in the shorter durations were higher in comparison to the longer durations. So people have a just like yes, things are going to settle down in the future, but right now we don't know what is going to happen. So in those high uncertainties, higher uncertain times, that leads us to this inverted yield curve situation.
Right.
Correct. So, and like these are the different examples, but we cannot say anything when we observe a flat or humped. So this is in 2007 when like the US economy was approaching towards that global financial crisis.
Yes, sir.
Yeah, and this humped is like just before this oil crisis or the Bretton Woods crisis of 1980s, 1980s. So this is like why we learnt about yield curve. This is the case because it gives us a idea like whether we are economy is in a good condition or it is going into a recession. In normal times, this normal yield curve situation should be there. So this gives like yes, economy is going well. So there are no higher uncertainties in like the shorter time period. So this was the discussion which we had in week 4, and if you have any other doubts regarding week 4, then like feel free to ask me, or you can post your questions on our Google discussion forum also. So if you have
One
any, yeah,
one question, sir, just out of academic interest. This recently there was a gold bullion, takeaway from the Bank of England. So it actually led to the short-term rates going, swap rates. I mean, short-term rates going over than the long-term. So there was, I mean, this I'm talking about the commodity rates, not yield curve exactly.
yes,
There was a backwardation of because the future uh, was less. The forward rate was less than the spot rate.
yes,
But it is said that it never happens in the bullion market. The last time it happened was again in the 1980s when that oil glut happened. So these are like temporary features which will get rectified, or
yes. Like as I said, like in normal times, like this should not be the case. But yes, whenever like there are these fluctuations, like these changes, the example you said, then it impacts mainly the short time period. So it increases the uncertainties in the coming periods. So for example, if you observe many of the times whenever there is a regime change, then you see like there is high very big fluctuations in like the 3-month treasury bill rates, not in the longer time period interest rates. So that is an observation which like you should have like whenever. So for example, it's recently during the time of US elections, during that time period. So for example, starting from October in October 2024 to January 2025, you should have a look at like 3-month treasury bill versus 10-year US government bond. Then you should have a look like how like these rates are changing.
okay. Sir.
Yeah.
And does the repo rate of the banks affect the short-term treasury bill yields, or are they unrelated?
They are related like the repo rate is like one of the key rate which is determined by the central banks. So I think few days before only, like our central bank, which is Reserve Bank of India,
Right.
they released the new data and they reduced, I think, the repo
Reduced.
rate.
Yes, sir.
Yeah.
Yes.
Yes. So how like these translate into the real interest rates? That is a like very big question in like the economics. So there are many channels through which they can be translated. So one is like, so these repo rate is nothing but like the rate at which RBI is, I think RBI is taking repurchasing from the banks, and reverse
Right.
repo is at rate at which they are like the
Lending to the banks.
lending
Right.
to the banks.
Right.
So this impacts the banks interest rates. So that is translated into banks lending and borrowing rates, like the at rate at which they are issuing bonds and the rates at which they are giving like the saving interest rate or the FD interest rates they are giving. So it gets translated into that, and through that they are going into the real economy. So this is a like very simple example of how changes in repo rate is translated into the real interest rates which are there in the economy. So if you see a like the reduction in the repo rate, then that will bring the real interest rates in the economy, like the interest rate which we see in day to day life, to that will bring them also down.
Right.
Yeah. So that is a like very different field of study which we call the monetary economics. So how like these changes in changes by the central banks or the monetary authorities, how these how like this we call central banks to be monetary authority. So how these monetary authorities like uh, why they make these changes and how these changes are like taking their form in the real economy. So that field we call that monetary economics, and which is a very interesting field to be in. Yeah. Okay, so in the at the end of last class, like I posed a questions to you, like which is like the how do we calculate the price of a bond. So I have provided the solution, and I will be sharing these slides with you, and you are free to like have a look at the solution and check with your own solution also. Okay, if you have any other question, please feel free to ask me or post it on our Google discussion forum. So in the first quiz, the content like the syllabus will be the content of week 1 to 4 only. So I hope like uh, the quiz one is I think scheduled on 23rd Feb. So I think we will have a quick recap session like during our session prior to that quiz. I think on 22nd Feb we have a session. So we will have a quick 10 to 15 minutes recap of week 1 to 4 in our regular live session.
So for the quiz, one question, will you be giving the present value interest factor tables and future value interest factor tables, or we'll have to do it by the calculator?
Mm, like uh, you have to do by the calculator, but not very hefty calculations will be given like those were given in the live says like the GH. So the calculations will be like
Up to two
not,
years, 3 years, like that.
yeah, yeah, like calculations will be much simpler in comparison to GH. In GH we give like very like the lengthy calculation because we like the idea is like you sit and you understand the concepts, but in the exams we understand that like there is limited time, so it is not for you to like the calculation, lengthy calculation should not be an issue in the exams. That would be,
Right.
yeah.
But I mean, it's just a suggestion that if these tables can be given, because it's basically we are doing 1 divided by the discount rate or whatever it is. That is the present value interest vector tables.
Yes.
So I mean, you could ask probably more questions, because otherwise there'll be a restrictions to the for the examiner also to. Uh, and these calculations, a person can tend to make mistake. But if you're saying they are not they're not going very deep in the number of tenure,
Yes.
then it should
Yeah,
be
I
okay.
think I think these tables are not given, but as far as I remember, like the calculations are not too hefty, like not many powers or many, like the
Okay.
amount of, like the not too many calculations are there. It's simple as that. Like,
Okay. So,
yeah. And if we will see in future if like this is a good suggestion, like we can give these tables and we can like the ask more conceptual questions in the exam. So
right. Right.
yeah,
Sir.
it is a very nice suggestion. So we will have a look at that also. Okay. Okay. Thank you everyone. So
Thank you,
we,
sir.
we will be meeting next week on the same time. Thanks for attending.